The best dividend stock is the topic of today's presentation. And when we start talking about best stocks, everybody's going to have a different definition of what best might be. Here's another way to think about this problem. If you could only hold one stock, what stock would that be? Now, what people will typically do is go back and look at the best performing stocks ever and then try to find the next Microsoft or the next Tesla. Now, we're going to argue that the best stock ever, not only the best dividend stock, but the best stock ever would be a dividend stock. And we're going to talk about why that is. We need to consider risk versus reward when we're thinking out. So if you could only hold one stock, and let's say you have 50 years left of your life, what should you be most concerned about? Well, we learned this in B school. The ultimate goal of a business is to survive. That's most important. So you can't have the company that you're invested in going bankrupt. So you may ask the question, what stock has the best chance of being here 50 years from now? Well, people typically, and you'll see this question posed on Twitter and they'll respond with Amazon or Tesla. You need to be careful there because technology changes very quickly. So focusing on the dividend income stream is very important. And here's why. So this chart was taken from our dividend growth investing report called Quantigence that's available to our premium annual subscribers. And what we did here is plotted the return of Altria over time. Well, NASDAQ plotted this. And you can see how the further along you get in time, the more contribution dividend has to total return. So the 30-year return that you see here, as you get towards the end of that, you can see how price appreciation is a very small component of total return, and dividends, growing dividends especially over time, are a significant component of total return. So when you're looking at dividend stocks, the dividend is paramount. It needs to not only be sustained, but ideally grow over time so that that growing income stream helps offset inflation. So a couple things when you're thinking out 50 years. Dividend safety is a priority. If you're not receiving a dividend, you're not receiving income, you're not receiving a meaningful chunk of total return that you should be. Dividend continuity, track record. So the way that we approach dividend and growth investing is the same way a hiring manager vets thousands of candidates. We start with looking at what's your track record? What have you accomplished? When we do that, we can then create a universe of stocks, as we've done, that have not only paid, but increased dividends for at least 25 years. Those are called dividend champions. And you can start with that set of stocks. And then it's pretty fair to believe that the best dividend stock out there would be in that universe. Now, you need to be very careful when you're evaluating dividend stocks and considering yield. So a lot of investors out there, newbies, will look at yield and say, well, this stock has a very high yield, so I should invest in it. High yields are a warning flag oftentimes. And when you're looking at quality assets, here's a couple charts for J&J. The one on the left shows their dividend yield history over 10 years. And the reason I put up these two charts is because they have differing data. So I didn't vet these data sources, but they accomplish the same thing. And what they show you here is that J&J's dividend never breaches 5% on the left. And I think the chart on the right is probably more correct, that it's rarely breaches the 4% mark. So people often say, well, I won't invest in J&J because their dividend isn't high enough, or let's say their yield isn't high enough. Well, the yield might never hit that target that you're hoping to attain because this is a quality asset. So why doesn't yield rise? This is very interesting. Stock price chart for J&J. This is a company that's not only paid a dividend, they've increased it for 61 years. Think about how much turmoil this company has navigated and still increased their dividend. Now, when dividend increases, so does yield, right? So if all things being the same, technically yield should go up over time for J&J. Well, when yield increases, people buy the stock. That drives the price up. When the price goes up of the asset, yield falls. So you can see how plotting yield over time makes sense. An increasing yield leads to a consistently increasing share price, as you see below. Now, that's not very sexy and not very volatile, but it's made a lot of people quite wealthy. So when we think about the best dividend stock, some criteria we might want to apply would be, as we said, a track record of increasing dividends over time. International exposure, not just America. It's very important because if America runs into problems, you don't want to have all your exposure there. When we think about industry, this is a very important decision to be made. We need an industry that's most likely to be resilient in good times and bad. So if you could only hold one stock, we might propose that it would be a conglomerate. What's a conglomerate? Well, according to dictionary.com, it's a corporation consisting of a number of subsidiary companies or divisions in this is important, a variety of unrelated industries, usually as a result of mergers and acquisitions. So, some popular conglomerates in our dividend growth portfolio would be a very good example, 3M, though they're navigating some legal problems right now, and J&J to a lesser extent, though they would still be considered a conglomerate. Would they when they spin off their consumer goods division? I don't know. That's something we need to take a closer look at. Now, what about companies like VF Corporation? So they're a portfolio of clothing businesses resulting from M&A activities. But since these businesses are all in the same industry, it's not considered a conglomerate according to our definition. Now, here's why this matters. The conglomerate discount has been proven to show that conglomerates trade at a discount because the market penalizes companies for a perceived lack of focus. That's very interesting. And there's a paper on this, and it talks about perhaps the simplest way to understand this discount is to understand how it's calculated. So it's a discounted valuation of the stocks associated with all the division subsidiary companies. So you simply value the intrinsic value of all the smaller companies within a conglomerate, you add that up and then subtract the market capitalization for the conglomerate. Typically, that will result in a 10 to 15% discount in valuation for the conglomerate. That's very interesting. So you're not only buying a asset that's discounted at any given time, we always want to be buying assets that aren't overpriced, but you're also getting a diversification effect from that asset. So it's as if you owned all those smaller businesses across multiple industries. That diversification effect is going to help provide stability. Now, when we think about industries, I pulled this from MSCI's webpage. This is a fairly recent edition, I think. It certainly wasn't there when I was working at MSCI. It's a beautiful chart that shows the global industry classification standard, and you can see across the top how there's 11 sectors. When I worked there, there was only 10, and they added real estate, and we used to send out queries to our client base asking them for their input, and sometimes CEOs would get on the phone and would be quite pissed when they were moved around or reallocated or reshuffled when they weren't paying attention to the industry consultation that they should have been. When MSCI makes changes to this, it's a big deal. And for example, here's an overview of the GICS changes for 2023. It's quite interesting read. They move things around, so they're splitting residential REITs into two distinct sub-industries, and they make all these changes to try to properly describe the market. So when you think about this one dividend stock that you want to own, which industry would it fall into? And you might ask the question, well, what industry does a conglomerate fall into? Good question. Well, MSCI has a team of analysts that describe what companies do by digging into their financials. I believe even when I was there, we were starting to look at automating some of that with some AI algorithms, but they'll dig in and figure out where exactly a company's money comes from, where their revenues come from, and then allocate them into appropriate buckets. So conglomerates and GICS, stocks of a feather move together. So for example, 3M is classified as industrial. So it will move alongside all the other industrials because it needs to be placed in a bucket, and that's the most appropriate bucket for it to fall into. But the underlying diversification effect, the collection of businesses, will create more predictable cash flows. The end effect of that is that it's easier to stabilize and grow dividend payments over time, unless you get hit by what we believe is largely a frivolous lawsuit that they hopefully can navigate their way out of. But the other thing that you need to look at when analyzing dividend stocks is the buffer. So if you expect them to increase that dividend over time, they need some buffer to navigate through recessions and whatnot. So payout ratio tells you how much of a buffer there is there. And so does debt, actually. And many people don't realize that, dividends are paid from profits, and profits can be on the decline for a while, and the company can still increase their dividend using debt, which is what oil companies have done in the past. Now, some of the more popular dividend stocks out there are in the consumer staples space, and this is another screenshot from our dividend growth investing report that shows how we calculate what's called Q scores. So you could see these factors that we consider: years increasing dividend, going back to that track record. Market cap, size matters. So companies that are large will be able to navigate the markets, would say, have a much higher likelihood of surviving than small companies. Yield, right? So we do consider yield in the calculation, of course, because income is important to dividend growth investors. Payout ratio, as we said there, international sales, and then we look at dividend growth rates. And the aggregate of these factors is a Q score. And there's actually a calculator out there. If you Google Quantigens and you go to our website that we put up, there's a calculator on there, and you can use this yourself to take a look. I think that the data may be in need of refresh. That's something that we're working on right now. But it lets you play around and look. The top 2 companies by Q score happen to both be conglomerates. Johnson & Johnson, again, whether or not they remain a conglomerate after the spinoff, that's we'll have to see. And then 3M. And you could see that both these firms have done a remarkably good job of increasing their dividend over time and growing it. So the next question you might ask is, well, where's a set of conglomerates that meet this 25-year track record criteria that we could then take a look through and see that perhaps in that set we can find the best dividend growth stock? It isn't necessarily the ones we happen to be invested in, Johnson & Johnson and 3M. We probably hold other conglomerates. I didn't vet our entire list of 30 dividend growth stocks to see, but these are 2 stocks that I've always said, if you had to hold one stock, it would probably be Johnson & Johnson because of the conglomerate effect, but also because healthcare won't go away. There will always be a need to take care of people. So that industry is one that won't be dying anytime soon. So when we go to Google and we look for the top 10 biggest conglomerates in the world, and we want to take a global focus there, this is where we start running into problems. You can see it just spits out everything, and it starts to talk about the 10 biggest companies in the world. That's not what we asked. So what we want to do next is take a look, create a list of conglomerates. So the list should be multinational. It should have a market cap cutoff, so we're taking size into account. And when we think about the best dividend stock, it isn't the one with the highest yield. It's one that definitely has a track record of increasing dividends over time. It's a large company, and we believe it should be a conglomerate. So you may disagree with that. If you do, put a note in the comment section and say why. And for those that do enjoy conglomerates, what's your favorite conglomerate? Please post that in the comment section. So I put up another video here that you might like. Before you watch that, please click the logo here on the right, subscribe to our channel, then watch this video next. Thanks so much for taking the time to watch this today.